In 2004, James Moria, just freshly appointed as the investment manager of Centum, made one of the boldest investment recommendations I have ever witnessed in my entire investment career. The Kenya Airways share was trading at 9 shilling per share, and he wrote a memo with a headline, I still remember, saying, "Strong buy with a target price of 110 per share." Granted, Kenya Airways was the best and the most profitable airline in Africa. Kenya Airways tagline, pride, or the pride of Africa, was truly the pride of Africa. We hesitated because how could he fathom that a share price could move from 9 shilling to 110 per share? But the share price began to rally, and it rallied beyond 30 shillings. And then we got convinced and we started buying it like it was going to run out of fashion. The share price persisted, and eventually it pierced through the 100 shilling barrier. And on 20th September 2006, the share price achieved its historical highest price ever, 139 shilling per share. Then other players in the airline industry began to crave for a slice of the pie in Africa. Emirates came in. Ethiopian Airlines also decided to come into the space. And a series of bad news, one after another, hit Kenya Airways. And today, I think for the last couple of years, Kenya Airways has made quite some substantial losses. And as naturally one would expect, the share price has taken a plunge. And today, the share price is hovering around 11 shilling per share. However, and the point that I really want to bring out in this video, there are quite a number of investors who have experienced the entire ride from 139 per share to 11 shillings per share. If you're one of those investors who continue holding onto loss-making investments for too long, then you're suffering from something that we call loss aversion bias. In today's video, I'll be explaining to you what is loss aversion bias, or why do investors continue to hold on to loss-making investments for too long. My name is Pius Mugo. I am the managing director of Nabo Capital, and you're watching Invest in Africa. So, what is loss aversion bias, or why do investors continue to hold on to loss-making investments for too long? Investment decisions are made from the mind and from the heart, and sometimes it's a little difficult to coordinate the two, especially when investors are dealing with losses. People generally hate losses. People have difficulty coming to terms with losses, and when people sell at a loss, they are literally admitting to themselves that they actually made a wrong investment decision, and that's very difficult to deal with. So investors sometimes tend to continue holding on to loss-making investments for too long, hoping that they will rebound. Even they go one more extent of buying at lower prices, hoping that with a lower break-even point, they would break even sooner. So this behavior is irrational and does not make any investment sense. And that is what we call loss aversion bias. And all investors, smart investors, should avoid loss aversion bias. In the next video, I'll be explaining to you as investors how to avoid the loss aversion bias. Thank you for watching. I hope this video has been helpful to you and you now understand what is loss aversion bias. If you want to engage us, please write to us on the email address that is on the screen. You can call us on the phone number that is also on the screen. You can also engage us on the various social media platforms, or you can even come to our offices at International House, 5th floor, Nabo Capital. you'll find us there and we'll be able to engage you more. My name is Pius Mugo, the Managing Director of Nabo Capital, and you're watching Invest in Africa.